Hi, everyone. So today I'm with Dom, and we are going to be covering Intact Financial, the insurance company, for Q3 of 2025. And Dom's going to get right into it.
Thank you. Can you see my screen?
Yeah, perfect.
Wonderful. All right. So, like Matt talked about, we're going over Intact Financial today. Just quick note, all numbers I'm talking about are in Canadian dollars, as the article states. So, just a quick heads up about that as I go over all the figures. So, highlights of the article. Operating DPW, which is direct premium written, growth increases 6%, driven by momentum in commercial lines and continued strength in personal lines. They have a strong combined ratio of 89.8%, reflecting solid underwriting performance across all geographies and lines of business. And then just a quick heads up for combined ratio. So this is basically a ratio for like how much premium you have written versus how much you're paying out slash costs. And so basically this ratio, if I were to give it a quick example, if I wrote 80 or $100 in premium for a policy, I'm expecting to get 89.8% of that is going to be paid out in a claim, and then the rest would be profit or revenue per se. So that's actually not too bad. 89.8 is actually pretty good. Every company has different targets for combined ratios for insurance, but high 80s isn't too bad. Anything over 100% basically means you're paying more than you're writing, than you're bringing in. So you don't want 100 or more. You want to have this number be as low as possible. But 89.8 actually isn't too bad. So we'll keep going, but just something to note for future if you're looking at other insurance companies in the near future for investing. Net operating income per share is at $4.46, earnings per share of $4.73, and this was supported by robust underwriting, investment, and distribution income. Operating return on equity is at 19.6%, return on equity of 17.3%, up 4 points from last year, so not too bad. And then they said the balance sheet continues to strengthen with total capital margin of 3.3 billion and BVPS of 103.16, an increase of 40% year over year. So again, not too bad. They do mention other numbers as well. These figures are actually some of the ones they just mentioned in that highlight section, so I'm just going to
All right,
scroll
great.
right through those. Their 12-month industry outlook isn't any different than Q2 of last month, or excuse me, last quarter. They basically said that they're expecting the similar stuff. In personal lines in Canada, they expect high single-digit to low double-digit premium growth, and then in commercial and specialty lines across geographies, which basically means across their world, across the world, they have different markets. They're expecting mid-single-digit industry premium growth. So not as high, but it is kind of expected a little bit just because you're across the world versus in one country per se. And they are based out of Canada, so it makes sense that they are expecting to do better in Canada than other places where they're slowly making a bigger presence in market share. Um, this part of the article just talks about some of the more stuff that they covered in the highlights. I did want to quickly go over underwriting segments. So this kind of looks slightly confusing, but all you need to pay attention to is these first two columns here, but I prefer it says the word change because this is Q3 of this year and Q3 of last year. I don't really think the year to date is as important. So we'll just kind of look at the Q3 of this year and last year as we go down and kind of talk about their different segments. So underwriting performance. They do have operating direct written premium in Canada. They're at 4.620 million, which is 4.6 billion, compared to 4.2 billion of last year, which is an 8% increase. In the UK and Ireland, they have a 1.072 million compared to 1.75, so a 5% decrease slightly. In the US, they're up. They're at 951 million compared to 871 of Q3 of last year, so 8% up. And so overall, it's about 6% more they've written compared to last year, which is good. Combined ratio, like I mentioned before, you want to see numbers that are lower, not higher. So at this time last year, they are at 109.5% for Canada, so they were losing money in Canada. Compared to this year for Q3, they're doing pretty good for Canada, 89.1. UK and Ireland, they're at 95.5. Compared to last year, it was 91.3, or excuse me, 91.9, so 3.6 points higher. Again, don't want to see it go higher, want to see it get lower. US doing well at 83.6% compared to 87.4 last year, so 3.8 points lower. And then the overall combined ratio obviously is all these averaged together. So you got 89.8 compared to 103.9. So I would say a pretty good improvement bringing this down because last year they were losing money. They were losing essentially 3.9 cents per every dollar written. You can multiply that up as much as you want with the percentages, but much better improvement in terms of profitability.
Okay.
And then I did want to go over quick updates they mentioned about each segment that their business is in. So they said in Canada, business is in a strong position, outperforming industry on both direct premium written growth and combined ratio in H1 of 2025. Their personal auto is increased by 11%, including unit growth of 3%. The combined ratio of 91.5% reflects strong underlying performance in the quarter, driven by benefits of pricing and risk selection. Personal property they have for direct premium written grew by 10%, including 2% unit growth. Combined ratio was solid at 92.4%, despite elevated cat losses of 16 points, reflecting underwriter discipline. Okay, good to see. Commercial lines operating direct premium written growth was at 3%, improving subsequently as growth initiatives began to gain traction. The combined ratio was strong at 82.8%, reflecting the benefits of our profitability actions in favorable prior years development in line with expectations. UK and Ireland, they mentioned that the direct premium written decreased 5% and that the combined ratio was at 95.5 due to them having due to them having mediation actions in the DLG portfolio and strategic exits. So I guess there was different businesses that they were exiting in Ireland and UK that weren't performing as well, which kind of helped to drive up their combined ratio. And then they also had unexpected cat losses that were higher. And cat basically just means catastrophe. So think like hurricanes, tornadoes, floods, fires. That's kind of what like a cat loss is, catastrophe. So I guess apparently there was a little bit more catastrophe losses than they were expecting. And then in the US, their direct premium written growth improved significantly to 8%, driven by continued momentum in both new business and retention. The combined ratio of 83.6% improved 4 points year over year, reflecting strong underlying performance. And again, that's a really great number. We love to see anything in the low 80s. Like I said, every company and business unit will be different what their target goal is for combined ratio, but that's pretty good, I would say. So overall, definitely doing good so far for Q3. It's not like the greatest quarter, but they're having a slight improvements in different sectors. Obviously, the UK and Ireland is the only one that's really kind of down right now. But overall, doing better than before as compared to Q3 of last year, Q3 of this year. So I'll let Matt take over now and kind of go over more of the financials of the company, and we'll dive into that.
Okay. Thank you, Dom.
Thank you.
Okay, so we're going to take a look at Simply Wall Street, but the thing with Simply Wall Street is that because the company has very few analysts covering it, there isn't a future free cash flow projection here. You just have free cash flow of 4 billion, so it's hard for me to judge whether it could be a double from here on out. However, if we take a look at, let's say, the revenue and the earnings, we'll take a look at something like the earnings. Okay, earnings are 2.98 billion, and it looks like it's going to be relatively about the same in the next couple of years. So if we check the financial health actually got a lot better from even when I covered it over a year ago. It's not bad. So you have a lot of equity. Debt is still higher than cash, but the cash is certainly catching up. And I think eventually there will be a higher cash level than debt, and hopefully they'll start paying that debt level off. So I don't think it's that bad in comparison to many of the other financial health sheets that we've seen before in the past. So I think that's okay in general. When we see my DCF as well, it's going to say that it's 51% undervalued, which is really good. I do agree with that. And even so, if we look at Simply Wall Street's going to say it's 9% undervalued also. So either way, it's going to be undervalued. And actually, right now, Tipranks is going to concur with this 9% undervalued. I believe they're going to say it is 13%. So let me just load that up very quickly. Yeah, it's a 15% undervalued. It's a moderate buy, 5 buys, 2 holds, 7 analysts covering. So it doesn't look bad right now, I would say, in general. And you get a low of 288. So yeah, I think overall it looks pretty decent, and it definitely seems more like a value play because the growth is, like Dom was saying, 5-6%. But that doesn't mean the shares aren't undervalued currently, which I definitely think they are. Dom, was there anything you wanted to add?
Uh, Nothing in particular. Just again, just want to reiterate that since it is kind of like a slow grower, it might be something worth watching. But like if you're trying to like double your money real quick, it'll take a while. So definitely something it's still like worth keeping an eye on, but it's going to be a little bit slower for the time being.
Okay. All right, great. Thank you, Dom. Thank you, everyone.
Thank you.